I'm Jeni Browne. It's not often you have the absolute pleasure of speaking to the CEO of a mortgage lender, and lucky for me, David Whittaker of Keystone Property Finance found some time in his very, very busy diary to be able to come and have a discussion with me, which we wanted to share with you. It's a wonderful discussion. In it, we're going to be talking about the future of interest rates, the future of the buy-to-let market, the renters' rights bill, all the things that actually are so pressing on landlords' minds at the moment. So I hope you enjoyed the video. It was really fun chatting to David. He's not ever shy on offering up an opinion or two. It was a really great conversation. So do have a watch, and hopefully you'll get lots of great information from it. David Whittaker, thank you so much for joining us. There's a lot going on in the mortgage market, and I think it's really confusing for people because on one hand, they're hearing that interest rates are coming down. And then on the other hand, and just as recently as a couple of weeks ago, we saw fixed rates go back up again. So what on earth is going on?
Gosh, Jenny, and if both of you and I knew the answer, we'd be sitting in a sunnier place and enjoying pina coladas or gin and tonics. It's a definite feeling of Groundhog Day at the moment, isn't it? It feels like last January when everyone thought we were heading towards a happy place and it all went in the opposite direction. And, at the moment, I could say, can we just roll forward to January 2026 and forget about this year? But look, I think there are some upsides to come in the year, but we're a little bit caught in the doldrums at the moment. And we all saw base rate finally go down on the 6th of February. That was only last week. And of course, borrowers will rightly say, base rate went down. Fantastic. Now, what are you going to do about my 5-year fix? And my answer will be, yeah, but kind of we knew it was coming and it was priced in. And that's a 5-year view and not the next 3 to 6 month view. So unless a base rate change is unexpected, the 5-year rates, or indeed the shorter term 2-year rates, should probably have that priced in. The boys and girls in the city have seen this kind of coming. And unless you're on a variable rate mortgage or sitting on a lender's revert rate, when it would have been particularly welcome, there was probably almost nothing to see here, sadly.
Yeah. I think what we find is that, when you have the base rate meetings, and last week would be the prime example of that, you immediately get a phone call or a range of phone calls from people saying, base rate's gone down. So, the fixed rate's going down now. But obviously the two aren't linked, are they, directly?
No, it's a slightly dysfunctional link, and the one nods to the other. And of course, the MPC sits every 6 weeks or so they meet about 8 times a year. And if I was trying to look forward, my thought process would be the next one would be due in mid-March, nothing to see. Because at that point, the inflationary effects of the public sector pay rises will be coming home to roost. It's 10 days ahead of the spring statement from the current Chancellor in number 11. You may choose to debate amongst yourselves whether she'll still be there in a few months' time. So you can see the Bank of England probably wouldn't wish to pander towards or against the current Chancellor. So you would hang your hat potentially on something on the 8th of May, which would be the next stopping point, at which point not only would her spring statement have become clear, but you'll have seen the resets on things like electricity prices and gas prices that come through once a quarter. So, I can't offer much immediate sunlight, a bit like just outside all of our offices today. It's a bit grey and it's a bit dull. But I think there are things we can pick up on and talk about into the coming year when you're ready.
Yeah, I mean, let's go for that then. Let's look forwards.
Well, let's deal with the unpleasant minutes. Look, we're suffering from volatility. And, I got to end of January, we'd priced up twice and we've now priced down twice. And I can see one or two of my peers pricing down again as everyone tries to find that tipping point that works for borrowers, but doesn't leave them with a product set that they have to run away from within 5 to 7 days. And we've seen in the last 10 days, 5-year swap rates go up by 0.15%, which doesn't sound a lot until you're the wrong side of that number and you have to run for cover again. So we try and adopt a policy that will take the pain for 5 or 7 days where we can, and then eventually bow to the inevitable if we have to. But when it starts going down and we're satisfied that there's no impending economic announcements that could destabilise that, we try and cut quicker. And that's sometimes a bit difficult because you're trying to manage pipelines, but the volatility is a problem. And then, of course, your borrowers and your clients will be agonising over the Renters' Rights Bill, which really is just the Renters' Reform Bill from last year, with a sprinkling and overdose of vindictiveness and spitefulness added to it, but in reality isn't much changed. And better informed people than I might have a date for it, but I think royal assent will come in about May to June time. It's in the House of Lords today for second reading, where it's going to get a bit of a rough ride from people trying to cut a better position for landlords in it. But when the government enjoys a supermajority in the House of Commons, I think it'll get mostly pushed back. But there are things that are worth bringing to the government's attention. So that needs to land, and normally you'd expect a 3-month implementation period. But just to prove that they have absolute power, they're talking about making it only 2 months.
Wow.
Because they can.
Yeah.
But the reality is 3 months is nowhere near long enough for the Ministry of Justice to organise its act, for the DCHLG who promote it to organise themselves. I don't even know what to write in my terms and conditions to my borrowers. Assured short-hold tenancies are going. We're told it might be periodic tenancies. And I said, what? Capital P, capital T, so it's a trackable thing. They went, what do you mean? I said, well, if you put it lowercase, it means nothing. You have to define a periodic tenancy. Oh, we haven't done that. So you're left thinking, this will land. But then let's try and remember, for the majority of our mutual clients, this is not a way of doing business. The Renters' Rights Bill is there for those situations where things have gone wrong. And the best thing we can all try and do together is try and make sure we don't end up at it. Yeah, there's 25,300 cases sitting in the Ministry of Justice system for Section 21. They would all be cancelled off. They would have been spread over, let's say, 9 to 12 months. So we pointed out to the civil servants that you're probably going to get most of those back in a new form under whatever basis you permit in the new law within 4 weeks of your act. And they hadn't even thought through the consequences of a number of cases eased out over a period of time against the majority of that number of cases, all landing back on them in a very short space of time.
Yeah.
So that needs to be got out of the way. But I emphasise that for the majority of your clients, and thankfully my clients too, this is not a day-to-day issue. Yes, it's a concern when it does go wrong, but I think we shouldn't allow it to alter our business strategies when we're looking at property.
Yeah. That's good. Thank you. And so in terms of, I guess, potentially trends for the market. So we know we've got the Renters' Rights Bill. And actually, before I go into that, I did want to ask you some thoughts about what we might expect to see in the spring statement, as I know some people are getting quite concerned about that as well.
I'd rather hope the word landlord doesn't appear in it at all.
Yeah.
Because if you do appear in the statement, it's a money grab.
Yeah.
And I think there is generally an acknowledgement that they have knocked the PRS slightly off track. And if they were to come back again with anything more, that would be significantly damaging to them in the ability of the country to house people, because the broader social housing sector doesn't have any slack in it and has no big building plans that would improve the position if a number of landlords were to vote with their feet. So I'm kind of expecting that she's got to try and avoid doing any tax raising, because she promised she'd never raise taxes ever again. But then, hey, she's a politician, and all politicians are casual with the truth. But, the economy has just about avoided a recession in Q4, only just. When you have to listen to the news and they're praising 0.1% growth in a month, you think, this is shameful. But businesses generally are feeling slightly cautious. But at some point, businesses rise above politicians and get on with it. They just need to know where the tram lines are. And I think probably there'll just be a lot of noise in the statement, and she'll hope that if rates are easing somewhat, that will take the pressure off her fiscal cap, and she can frankly try and make it a nothing event, because anything beyond that, she'd look remarkably foolish.
Yeah, yeah. Actually, just on the subject of the fiscal cap and Rachel Reeves and that kind of stuff, we had a bit of a thing with the bond market last week, and we saw the rates of the week before last year, and we saw mortgage rates go up, didn't we? And I think one of the things that a lot of people don't necessarily understand is that gilts link into swaps, which link into mortgage rates. And actually, from someone who doesn't kind of do this for their job, it's really, really confusing. And I can't think of a better person to explain, David, how these things all hang together.
Well, trust me, I go and ask people far wiser than me in the city to explain it. The old adage of America sneezes and we catch a cold is as true today as when it was first coined 25, 30 years ago. So there was an expectation in America that the Fed would be cutting rates during 2025, and they'd be doing it by a measurable quantity. That position has been significantly rolled back, not just by the presence of Donald Trump in the White House, but by the sense that actually American businesses are getting on with it. And therefore, why would you run the risk of runaway inflation by stoking low-level interest rates? So what they say matters. It wasn't helped by our own political class making their normal round of inept comments about all sorts of things. So what happened here was just the icing on the cake of a readjust that things weren't going to reduce as much in America, and therefore we bowed towards America. But as you say, an unwelcome spike up when we would all still think the trend this year should be downward, but not highly significantly downward. So we put a stake in the sand in October and said we would really welcome base rate at the end of 2025 being 4%. If it went a quarter point below, that would be really nice, because that's encouraging to people in the more general sense. But the reality is, whether it's 4 or 3 and 3 quarters makes not a halfpenny worth of difference. Out of which then comes the beginning question you put to me: well, how does that affect swap rates? Because swap rates tend to be longer. That suggests another cut of 2 more cuts of 0.25% in probably a couple of quarters out from here. So perhaps May, perhaps in November. Swap rates might come down about 0.3, 0.4 over that time, because there's no sense why over a 5-year push it would go much lower. So you could see 5-year swaps that we've been grumbling about are about 3.9 at the moment, or 3.95. You might see them down to about 3.5 if you were lucky. But there is no silver bullet. There's no good news silver bullet that would allow them to come down more. And if they were forced down lower than that, that would be because of something geopolitical, which would not be so friendly at all. So I think we have to try and manage our expectations and our wishes to say a moderation would be good. It would give more stability to the market. So when we're looking at pricing, some of it is the function of the volatility. You end up with an extra 2 or 3 basis points in every product because of the volatility swings, where if that dropped out, you could price finer to the point rather than having to hover around the point, which is a challenge everyone faces at the moment.
Yeah, that makes sense. You're having to almost build in a buffer just to kind of cover yourselves if things swing a little bit. So I'm hearing there, and I've actually written this down so I can quote you on it. Base rate 4% by the end of the year, and fixed rates probably ending the year sort of circa down by around 0.3% from where they are today, roughly speaking.
Perhaps a bit more, but to aim to see them in that range, 3.5, 3.6, doesn't sound a big change, but it would bring pricing down more generally. And it's about, if you were taking then a 5-year rate and you were 35 basis points cheaper, the benefit to you over that period of time would be 1.75% on your financing,
which is huge, isn't it?
Which over the longer term is big. And just to mention the renters' rights bill again, it will force rents up bizarrely.
Yeah.
So your landlords and landladies, whether they're trading personally, partnerships, limited companies, it's the arbitrage. Their rent is here. What's the difference to where their interest cost is? And if the rent's going up and the interest rate is coming down even slightly, It's that differential that really empowers them to decide to go again with a new property or refinance the property and lift some equity out.
Yeah.
So it should feel better by the end of the year. And the predictions for the market for 2025 is that last year, with a low prediction of 26 billion, it went up to about 32 or 33 billion, and we're literally waiting for that last month of data now. Their starting point for this year was a cautious 33 billion, but given the conservative nature of their last year bid, I've seen other reports suggesting 36 to 38 billion, and that's just on purchase business and remortgage business. We can talk PTs if you like in a moment, but those are the major drivers of the market, and that says to me that landlords in the collective noun of landlords have got their boots on and are generally more active one way or another.
Yeah, it certainly feels like that from where we're sitting. We're starting to see it's got an increase, a gentle increase, but an increase nonetheless in terms of activity. And I suppose really from the Renters' Rights Bill perspective, because quite a few of our clients, they're kind of really thinking through the unintended consequences of things. So from a lender's perspective, are you going to need to change the way that you underwrite mortgages, how you value properties because of the change in tenancies? I mean, what does this actually mean to the lending market, do you think?
Well, unless they throw a late curved ball, we are sort of the agnostic friend in the room. So we're concerned for our landlord clients. We've made representation to the government through various mechanisms. Ourselves as Keystone have with Paragon linked up quite closely with the NRLA to give them both moral support and sort of technical support. So it doesn't affect any way we underwrite. It doesn't affect any way that valuers value, because with the exception of HMOs, you are assuming always a vacant possession. And I get that it'll be somewhat more sticky to get VP on a house or a flat if we ever found ourselves in that position, but we don't start underwriting for that negative point. We work on the basis that if it were not Mr. and Mrs. Smith living in it, it would be Mr. and Mrs. Smith renting in it, and we don't have a definitional difference on the valuation. So I wouldn't expect, and I'm not hearing any words from our friends over at the RICS who represent the valuers, there's no sense of them being bothered that this impacts any valuation assumptions.
So there's one bit of good news for us then.
Well, take your wins where you can.
And I think really just to kind of, I suppose, wrap up, David, you've obviously been in the mortgage market for a really long time. Not that you're that old, by the way, that sounded awful.
I am the oldest man in the room.
You have a vast amount of experience. You're obviously in the thick of in PRS and also the lending world as well. So in terms of advice to landlords for, say, the coming 12 months, what could you share with them?
Well, I wish I had a crystal ball that did find a silver bullet for us all, because obviously we thrive and prosper as much when landlords do, and when they don't and they feel on the back foot, we kind of share the pain with them, but not in quite the same respect. I think what will be different this year is lenders are much more tuned to the needs of landlords, and we think that you'll see a very active remortgage proposition from many lenders out there who will effectively cut their throats to attract business in. So it's always worth the landlord, when they come towards their reversion point, engaging with their broker and say, right, we've got a PT offering here, it looks pretty good, but is there some lender out there with a pressing need to get mortgages on their books who's prepared to commit? I'd always say financial harry-carry. I'll never do that, but some will for good reasons. Let's see what the options are. You're right, you have the uncertainty of execution, a certain amount of effort and cost. But then you'll see lenders growing out their PT programs to include further advances. We've led the market on that at Keystone for about 9 months. I'm surprised no one has yet taken our offering and taken it one stage better. I'm sure someone will soon. But the importance of understanding that lenders are trying to flex towards landlords to create better solutions should never be underestimated. And with the first consultation paper coming out on the EPCs yet again, where they're dragging that first date forward again to 1st January of 2028, which is really quite close. Yeah. You've only got somewhat less than 3 years to get to that first tipping point, you'll see lenders such as ourselves coming out with products that say to landlords, we can help lift that property from the low D to a C, and then you can access a new product range. And you'll see people who've done it before quickly dusting something off the shelf. We've got something nearly ready to go. So we're cognizant of the challenges that landlords face. And I think we'll try and bring some better products to the table that feel sharp, easily deployable, that you guys can take to the landlords and say, look, you've got two options here. And the third option is not to sell. What do you want to do? Do you do a PT? Do you do a remo? And I think hopefully we can look back in May, June time and say, well, quarter one felt a bit uncomfortable. Do you know what? This feels a bit like business as usual.
Hallelujah to that, definitely. But I can't think of a lender who is more kind of aware of the borrower's side and the challenges they face and working to find solutions to really kind of help them to be able to succeed in their business. That's really good that you guys are already considering the EPC thing, because it kind of went off the radar for a bit, didn't it, after the Conservatives shelved it, but obviously it's back on with a vengeance now. So I think a lot of people have now got that to worry about as well at the moment.
And sadly, it comes from a different department to the Renters' Rights Bill. And it's almost like you need to introduce them. And they're sort of agnostic to the needs and the outcomes of the one to the outcomes and consequences of the other. And of course, this comes from the Department of Net Zero and Collective Ed Miliband madness. You've seen how he doesn't care. He's an eco-zealot who are the most dangerous people on planet Earth. And you know it's not deliverable in its current form. So what are the workarounds that we and you and your clients will come up with to make sure we get to a better landing place, whether it's 1st of January 28 or 1st of January 2030, when it's older style, well, not older style tenancies that haven't been renewed.
Yeah, absolutely. Much to think about. David, thank you so much. I know I always really enjoy hearing your thoughts on things, and really appreciate you taking the time. You're a busy chap, so thank you for joining us today.
Yeah, an absolute pleasure. And I just say to your landlord clients, and I used to sit at a desk with you guys talking with landlords all day long. Your resilience is remarkable. Your fortitude in the face of adversity is highly commendable. But ladies and gentlemen, keep your glasses half full and not half empty. Good luck.
Thanks, David.
Bye, Jenny.
So there we go, never fails to deliver on a fascinating conversation. David's knowledge is incredible, actually. He's been in the industry for a really long time. It's an absolute privilege to have had some time with him and to be able to share it with you guys. I hope you enjoyed the video. I hope you found it useful. If you did, please do give it a little thumbs up or some comment. You guys who use YouTube know how important these things are. And do subscribe to our YouTube channel, because actually there you're going to find lots of great content just like this one. Thank you so much for joining us. And if you have any questions, you can always reach us 0345 345 6788. Look forward to bringing you some interesting information and content very soon.